Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Swing Trades Using Options. What I like to do in these videos, folks, is talk about simple concepts and then build on to real life examples. So what I mean by that is we're going to talk about different types of swing trades in simple concepts, and then I'm going to build on that and show you some real life examples. Finally, we'll spin around and find some option strategies that fit in that directional assumption as best we can. All right, we're finding the best strategy for any given situation. So throughout this course, we've already covered a lot of the strategies. Now what we're doing in these exotic strategies is layering on a component to a strategy we've already learned. For instance, this one's going to be the straddle, and we're going to limit the risk on one side of it to eliminate any mishaps that might be kind of in the back of our heads there. So without further ado, let's get on with it a little bit. First off, we are going to be doing, like I said, the straddle with no downside risk. But before we get into that, let's talk about swing trades and really what is swing trading. It really is a very simple concept here, folks. And what we're looking at with swing trade is just trying to decide if this market is in a bullish move, a market neutral move, or a bearish type of trend. All right. So there's three things we want to find: the trend, the support and resistances, and then ultimately the pattern. The pattern is what we're going to base our trade on. But before we get there, let's talk about how markets ebb and flow all the time, right? So we see markets, even though they're in a bullish trend, we also see these ebbs and flows that go on within that trend. This is a neutral trend, and we see some ebbs and flows going on sometimes, right? Same thing goes with a bearish market, right? So ultimately, we find that trend. This is a bullish trend, market neutral trend, and a bearish trend, right? And then we kind of squinted our eyes there a little bit, and we kind of negate some of the noise and try and find out where it hits most often on these support and resistances. Now, if you are newer to trading options, I try to hit as many of them as I can, but folks that are newer to trading, I would suggest kind of going a little bit further out and just hitting those outside moves, if you will. So mine might be in and along there, whereas another person's support and resistance might be a little bit further out to try and not hit as many, but try and hit a few of those, right? So now we found the support and resistances. You can use Fibonacci's. There's all kinds of different ways to in order to find your, you know, I keep doing this lately, and you're right. I'm glad Sal's on this. All I see is your face. That's right, because I blew it. So when we're talking about markets, we're talking about a bullish move here, bearish move, and bullish move. Pen, I can see it going on and it stops. Make sure you got it on there. All right. So we've got our bullish move here, right? That's the trend. We've got a market neutral trend and then a bearish trend here. Okay. And then we try and find our resistance and support by trying to draw our line in there and hitting as many of the ebbs and flows as we can. Now, if you are a newer trader would go to the outer band there, and this is kind of a seeking risk. I seek some risk. I'm going a little bit tighter, higher risk tolerance. All right. So newer traders start further out and then slowly start moving your parameters in a little bit tighter. The tighter you are, you're going to have more opportunities. The further out you are, you're going to have less opportunities, but those opportunities that you take are more likely to be winners, if you will. So not all of them will hit, but you're going to be putting yourself at an area where you're not going to have to take as much heat for it to work itself out. So let's go to a real life example. This is an old snapshot of IBM, because I think IBM is one of the better type of stocks to trade if you are newer to trading, because it does have a pretty finite range that it likes to stay within. Usually between 110, 115, and 135 is usually the biggest outlier. So somebody with a support and resistance there. Since we started talking about this, the extreme has just shifted up maybe $10. So the low end's down around 120, the high end's right around 145, if you will. But we'll show you those examples as we go along here. With this though, obviously I'm going to be looking at a market neutral trend, right? Because we're moving completely sideways. And then we look at our ebbs and flows in this market, kind of similar to what I was looking at with mine, right? Maybe pretty sloppy, but what you can see is that if you draw a line here, there is a resistance there. I would say that if you are a lower risk tolerant person, you might reach out to the further line. Again, here's my line in the sand, and then a person that has a lower risk tolerance or newer to trading here would be what I look for. So now we found that it's an overall trend. We're now looking for, and we found our support and resistance. Those are the first two steps, right? Find the trend, find the support and resistance. Now we need to find the pattern within the trend. So you're going to be keying in on candles that look like this at the top of a move, because that really tells us the psychology of what's going on trading here. We've got bulls and bears banging heads right now in this market, and one of them is going to lose. Now, I usually get in on this setup candle, which is the one that is giving us the first indication as to some weakness or that the pattern might be rolling over. So when you're doing that, I want you to look for some key candles, some that have the hammer all the way down to the bottom. Some will have a little bit of a wick at the bottom there, all right? Or they can be flipped upside down. So these are some of the four really major ones to look for getting into trading options. So you're going to look for this at the top and the bottom of a move. Then what we're going to wait for is a confirmation. Just so you guys know, these candles can be either red or green, hollow or filled in, just kind of depending on how you like to set up your candles. I like to have them filled in generally, but it doesn't matter either way. So they can be red or green there. And there's also one that looks kind of like that. They call that the tombstone doji. But you can see right here, we are looking at one of these dojis. I would want to wait till the next day if I'm newer to trading or swing trading, okay? What I would want to do is find this strategy, and then when the underlying trades below that and closes, so the next day you get like a red candle there, a newer trader, that's what I would wait for. That's the confirmation. So you get a red candle at the top, in a sense, what we got there. And then next day, you get a candle that starts trading and closes out below that previous day's low. That's confirmation that there is a top and the market wants to roll over. Vice versa, you could have that candle at the bottom of a move, same candle, right? At the bottom of a move, that would signal that the market has found a bottom, at least for right now. But you would want to wait for the confirmation candle if you're newer to trading options, which means then it closes above that previous day's high there. So that would confirm the market wants to move higher. All right. So those combinations, these are not added together. These are all mutually exclusive when we're looking at these different types of candles. When you start combining them, they get a little bit more powerful. So for instance, this definitely a sign if you see those two candles side by side. At the top, we're talking at extremes. I'm not talking about in the middle here in this area. You don't want to look for those candles there because they're not as impactful. We need to wait for them to be at extremes when those bulls and bears are really battling it out, where the bears on a rally are giving up, and on a sell-off, the bear or the bulls give up and sell out of it. And that's where that compression comes in these candles. So let's move on to a real life example. Well, we can see that this is relatively negative as we're going here. Now, something to note, Best Buy, I'm going to talk a little bit about fundamental and technical. Fundamental, these folks were supposed to miss on earnings. I think it was like maybe, I'm going to say 5 cents or something like that. And they missed on 25 cents. So pretty big deal. brick and mortar, not doing too great, especially the tech. Everybody, this isn't tech, this is Bed Bath & Ball. I don't know if anybody goes to Bed Bath & Beyond. Anybody out there going to Bed Bath & Beyond, hit me up on the side. I might change my thesis on this trade. But what my thinking is here, yeah, we have broken above. You can see there's one of those candles we're looking at, counter opposing. So we've got a candle like this, and then another candle lining up next to one another. Now, remember I said mutually all by themselves, you're looking for those top and bottoms. Usually when you get mirrored images, it usually leads one to believe that the market is going to want to move higher. But I continue to get those mirrored images. So for me, this is a battle of the bulls and bears going on, and it's kind of continuing. But we're also seeing the volumes really slack off here, right? If you look at these volumes, they're pretty low compared to what we've seen in the past. Now, that also tells me there's just not a whole lot of trading going on. It's just really maybe not bulls and bears, but just kind of people trading back and forth at this price, because we're at this point of control. And a point of control tells us a lot of things, folks. It tells us the psychology of the market, most importantly. It tells us where the market has found value, and that is right here at this $15 mark, because that's where the most people have, or that's where the most amount of transaction, that price of $15 is where everybody's transacted. So if you think about it from the trader's perspective here, the trader is used to seeing 15 trade constantly. So there's no angst to get in or out, because he's probably already gotten a trade at $15 before. So he's not too worried about that pricing there. It's just going to kind of flutter back and forth. So with this trade, I actually believe that we are going to start trading within a range. And because we are talking about Bed Bath & Beyond, I think that there is really no risk to that upside. I do not see Bed Bath & Beyond making any kind of rally coming out of this pandemic. It's not like we're all wanting to rush to go to Bed Bath & Beyond, right? Unless you haven't seen that product on TV yet. You know, they do all the ads seen on TVs. Anyway, so I do think it's going to stay within a range, but, you know, I am worried about Bed Bath & Beyond to continue to the downside here, because I just think that that company probably is going to struggle going forward. Having said that, if it stays right here at the point of control, right? If it stays right here at the point of control, that's where I kind of believe it's going to. I want a strategy that gives me money or pays me for being correct at the underlying staying right there. All right. Another thing to note, we have to look at implied volatility over here. Implied volatility, this little chart over here on the side, is something that's very important. Why? Because it is the thing that really determines or tells us, conveys to you and I, whether or not the pricing over in the option montage, which is that page with all the strikes on it, that it tells us if that pricing over there is expensive or if it's cheap for trading. So if it's at a really high level, one thing we know about implied volatility, which is just Vega. Have you guys seen Vega over there? Implied volatility is Vega. It's just a fancy name over there in the option montage. So as volatility or Vega starts increasing, then that means the prices in the option montage are increasing. Now, I'll show you this when we pull up that platform here in a moment. But if we see that this mark here is at some of the highest levels we've seen, then we know that the pricing in the options is the highest we've seen. All right. And vice versa. If it's way down here at these low levels there, then we know that those prices are super cheap. So that would lead us to want to buy cheap and sell expensive. That's exactly what we do in options. So if we move on to looking at some other ideas, why options? Well, there's several reasons, but I'll give you a couple of my main pointers. One is you have better odds, or better probabilities is really what I like to say, but I don't want to write it all out. But you have better odds. You also, you know your risks. All right. In this case, we're going to know what our risk is to the upside and the downside. Now, you might be able to say, well, hey, I think I know that when I buy a stock or short a stock, I know what my risk is there too. Yes, but with this strategy, we know our risk for the most part, but in general, with options, you know off the bat that you have better odds than just going out there and buying a stock. You know that you have less risk. You're also going to be playing with lower margins. So for instance, if you went out there and bought 100 of the underlying, if I went out and bought 100 underlying XYZ stock, well, my margin, if I'm on a margin account, is usually about 50% of that. So if I bought 100 of a $25 stock, that's $2,500. I'd have to put up about $1,250. Well, with this strategy, I'll put up 600. So it's half of somebody that's trading in a margin account, and it's like 3/4 less than somebody that's not in a margin account. So you are definitely going to have lower margins than you would if you went out there and bought the outright stock, no matter what. Now, on top of that, if you trade like synthetically with these trades, you're going to have lower margins. When I set it up as acting like a real stock, the lower margins with that trade will allow somebody with a smaller portfolio have more opportunities in different underlyings. You know, a lot of times when you're looking at the charts, you're thinking, I have like 4 or 5 opportunities on any given day. And you kind of might be thinking, I don't have that much money to put all 5 of those trades on. So you start trying to figure out which one you're going to do. Well, think about this. If you had had to put up half the margin, then you might likely be able to implement 1 or 2 more of those strategies. Does that make sense for you? Hit me up over there on the side. If you guys have any comments, questions, or anything else, throw it over there on the side. I want to make sure you guys are clear concept. Before you go, smash that like button for me. So you also, you know your risk, you have better odds, lower margins, and you are going to be more confident, all right? Because all of this thing, when you know what you're getting yourself into, you're going to be more confident in it because I know what my risk is. When you're going out there and buying a stock, you just don't necessarily know. You're beholden to what that market does that moment. So I like to use options because it gives me a little bit more wiggle room. I don't always have to be directionally right. So when you're buying a stock or shorting a stock, you have to be directionally right immediately. So I like options because I can be wrong and still make money. All right. So back to this IBM. If you guys remember back in that last snapshot of IBM, we were looking right here at this candle. And this is why I was saying, wait for the confirmation. This one never got confirmed. As a matter of fact, the next day, it blew the lid off to the upside. Now, why did I use this as an example? Well, when we were looking at IBM for this, on this trade, I basically sold the 137 calls up there. We had high volatility. The market was moving higher. Sell some 135 calls. Well, blew off to the, or 137 calls. You can see it blew off and printed a new high, testing my short calls. Now, I stayed in this trade because I knew what the probabilities were. And I knew that this was basically the high we've seen for the last several years. So I didn't really worry too much about it. Usually that first time, especially, you get that print. Anybody who hasn't seen that price the entire year is trying to dump those trades because they've never seen 137. I'm going to be the first one to sell 137s, right? So you're going to get that pullback, especially at 52-week highs on a candle that we got, like we were just talking about, a spinning top doji like that. The next day, though, it gets confirmed. It goes below that previous day's low and closes out there, meaning that the pattern is shifting, okay, to the downside. So you would take advantage of it. I was able to stay in my trade. Now, if we go back here, way back machine, we can see that the market did actually continue a little bit higher from even that point where we were out of our trade, but the market did start moving higher again. Well, it didn't last long, though. Look at that. I mean, literally almost immediately, what did we do? We went right back down to that 114 area and would expect to kind of stay within that range for a little while because we've got that point of control right there. Doesn't always happen, but those are the ways that you're thinking about with these levers and pulleys. How is it possible that there are really Only 3 people here. I think that you need to have a better way to distribute info when they're finding videos and meetings. I agree with you, Sarah. I totally agree with you. You know what? A lot of our subscribers, though, get this video sent out to them afterwards. So it does have a tendency to get some more views, but most of those folks like to watch it on their own time. But I do. You know what? Great. You know, it took me a while to find it because you lost the link. Sarah, you know, if you write down there next to it, there's a subscribe button. You probably already subscribed, but right next to it, there's a little bell. And that bell will tell you when I'm popping in here. Because I even do daily market commentaries where, you know, we don't really have a scheduled time for it. It's really when I see an opportunity in the markets and I'm going to pop in there. So not a scheduled time. So that little bell will let you know when I'm hitting the live button. So that might help out as well. All right. All right. So back down to this area, down to that 114 support, value area low, great time to buy. We get a little bit of a bounce, I bet, on that move. And look at that. It ripped all the way back up to the value area high. That's why I love IBM. It has a tendency to find those support and resistances, and a newer trader can easily take advantage of that. Appreciate you, Sarah. Appreciate you. Thank you. So again, then you get another pattern. We got another one of those candles, an extended long wick with a little spinning top doji at the top there. So I would look to take advantage of that. Now, when we're looking at one of those tops, you could have said before this didn't get confirmed, we've got that little candle right there. Well, it's still in the middle of all this kind of mess in here. It's not at one of the extremes. So newer traders, wait for those extremes. All right. Appreciate you, Kevin. Thank you. Appreciate the kind words. All right. And then we go and look, we got that confirmation the next day. So even a person waiting, you know, I usually get involved in the setup candle, the confirmation candle right next to it. Market rolled over, right? You know, it got a little bit of a bounce, hung out at that point of control for a little bit, but you know, right back to 135, folks. That's that spot that we've been talking about for almost a year. I mean, I've been taking these snapshots of IBM for as long as I can remember, and it's really not going anywhere. As a matter of fact, folks, this is the first, IBM was the first stock I really started trading options against. It was IBM and Walmart. IBM was always trading around 100. It'd go up to like 110 and then basically roll back over to 95, get above 100, start rallying a little bit. And I was getting so frustrated that, you know, it paid a good dividend, but it really wasn't going any higher so I could make any money. I just was watching it fluctuate. That's when my discount brokerage house came to me and said, hey, you know, think about selling some covered calls. And then sold the covered calls. Of course, it blew through and got called away. Now what do? Well, sell some puts and get them back. All right. We did that and it got them back. So kept playing around with that. That's what really got me interested in trading. So something with this, having that rollover and back to the point of control, you know, it stays within its range. And for Bed Bath & Beyond, I'm expecting it to stay right there. Very similar to what we saw with IBM. Maybe get a little overextended here and then pop back down. Could go a little further than below the point of control, test that value area low or something like that. But I don't care about downside. I need to get rid of any downside risk there. So that's already in my head because I just don't like this company. I just don't think it's going to go back to where it was in its heyday. I don't think it's even going to get up anywhere close to 30 to that time volume. That's also a point of control, that one up there higher, but that's just a price there. Nobody's transacting there. They're just kind of sitting there looking at it like, really? It's at 30? So the longs don't trust it. The shorts don't trust it. And the market starts rolling back over. So time volume nodes, albeit they are important because it's a psychological thing that folks have gotten used to seeing that price. But the transacting, where down here where you get the volume, that's where people are putting their money where their mouth is. That's where people are actually putting their money to work, meaning they believe that's where value is located. So I would be happy to get in there because the folks that believe that's where value is located has already probably bought it there. All right. So with that said, I have high volatility. I think it's going to stay right there at that point of control. So basically a very sideways move with high volatility. If we get that sideways move, volatility will come out of that underlying and the prices will contract. Even if I'm directionally wrong, prices will contract if volatility comes out of the strategy. So I have told you time and time again, probably at this point, I am looking for us to stay within basically that kind of range, but I do believe we'll kind of narrow it down. So, looking at probably like 20 being the extreme high for me, and to the low, would be, let's just say 12.40, but I'm not even worried. I'm going to eliminate this so I don't even have to worry about that. Just going to be worrying about the high there. All right. So if we're going to do the straddle with no downside risk here, what we want to do is look at our underlying. We start out here. I notice that the volatility is high. Elevated levels. I already told you elevated levels. If volatility increases, the price of our premiums increase. And I'll show you that in just a moment. We're almost there. But if this volatility comes out, I could be directionally wrong. This underlying could start rallying higher. If volatility comes out, it could completely offset me being completely directionally wrong. So those are things that I have in my head. If it does move higher, volatility comes out, I'll be good. If it points right here at the point of control, all good. If it goes down, I'm not worried about it. I'm worried about the downside, don't get me wrong, and Bed Bath & Beyond. That's why I want to limit that risk to the downside. But by doing that, I'll be happy if it goes to zero. So if we did this setting it up like the straddle, you're going to go, a straddle is as simple as going to the at the monies. The at the monies are the ones that are trading closest to where the underlying is. Last trade 17. I'm going to the at the monies. I'm going to sell the 17 calls and the 17 puts. So I'm going to sell one here and then sell another one there. That creates this straddle down here, right? I'm collecting $4.34 for that. So that means if we were looking, I'm going to uncover that so that you can see it. $4.50. Remember back to when we were doing the straddle in a short straddle, right? If I collect $4.34, my break even is $4.37 away from where we currently are. So $17, 21 to the upside. So I've got $4 to the upside, 21 to the upside, collecting that, right? On this straddle, $4 plus the 7.21, and to the downside, minus $4.34. I've got basically, what is that? $12.66. So to the downside, that encompasses what I was talking about, right? $20 to the upside, the $12 to the downside. If it stays within that range, that's what I was just talking about with those just lines in the sand. I think it's going to stay within those. Well, now with the straddle, high volatility, those premiums are jacked up, allowing me to get that big range for this little underlying. I mean, basically, I'm looking at almost a 20% move, right? So I'm good with that, but I want to eliminate that downside in case that happens. So if I go out here to the left, or sorry, wrong way. If I go back to this chart, this is what I was talking about with volatility. Now we have to look at Vega in relation to the same underlying. We can't look at this Vega versus Facebook's volatility. So I want to look at apples to apples. This 108 number in relation to Bed Bath & Beyond's volatility. But every time this increases 1 percentage point, our premiums are going to be reflective of this adjustment. 1% means this goes from 108.51 to 109.51. 2 cents is going to add in there. Now, you might be saying, hey, that's not very much. Well, it's at 108, folks. That moves like 10 ticks at a time. That's 20 cents out of both sides, because volatility is going to affect both of these the same. If volatility increases, both sides are going to increase. And if volatility decreases by 1 percentage point, all of those become negatives down the way. All right. So we want to get involved in something like this. Sorry, I'm going the wrong way. We want to get involved in something like this when volatility is really high. Another thing somebody was asking over there on the side, if volatility is really high, that means these premiums over here are super expensive, right? Because it's at the highest level we've seen. It doesn't matter if I'm looking out here at this time bracket, or this time bracket. I know, even without looking in there, by just looking at the implied volatility chart that I had there, I can tell these premiums are the most expensive I've seen, or some of the most expensive I've seen, I should say, in the last year. I just know it for a fact. Even if I didn't see it, just by looking at that number on that chart, if I never even looked at Bed Bath & Beyond before, I would immediately be able to recognize, because that volatility is so elevated, that these premiums are elevated as well. And therefore, it's something to sell. All right. Now, the next piece of the puzzle is, if you are selling options, meaning if you are collecting a credit, your overarching goal is to sell high and buy low, right? If I'm selling something super expensive and I know it's super expensive, so I need to sell it in order to collect that big premium, well, what do I want to happen? Do I want that price to go higher or that price to go lower? I want that price to go down, right? So one of the things to make that price go down, I talked about it. Volatility goes down, right? Another thing that we can have help us is have theta work in our favor. Now you can see theta on both sides, whether it's calls or the puts, theta is negative. It's the only Greek right there that is consistently negative. Yeah, delta is negative on one side, but not so much on the other side, right? But like volatility, where it's both positive and it increases and decreases with that volatility moving, well, theta is the thief in the night that comes and steals your premiums, folks. It means every single night he comes in and picks your pocket. Well, if that's true, and I've sold something and he's taking a couple pennies out every night, what do I want to have happen? I want him in my back pocket. I'm going to be opening it up, right? I'm going to be, hey, over here, free money, right? Well, something to note with volatility, it affects the nearer duration options more. The closer you get to expiration, theta is going to increase. All right. So way out here in time, this might be like 0.001 penny, right? And now here it might be 0.01 penny. Here, moving in, might be 0.011. Okay. So it doesn't even get up to really 3 until here. So you can see way out in time, theta really doesn't get very aggressive. I want theta to start increasing. And as we get closer to expiration, it's going to incrementally increase. So if I'm ever selling options, if you're selling options, you want to get inside of, you want less than 35 days. 35 days to expiration is the sweet spot. But, you know, less than 45 days is good. So really, I like to set up inside of 45 days. If you can nail it right on 35 days, we're at 47 or 37. So that's pretty close to that. So I would want to jump on something like that. Selling options so we can buy them back if we're directionally wrong. You know, you want to get all these levers and pulleys in your favor. Now we can see with this strategy, $4.34, that is with the option contract multiplier, because remember, every single one option contract is equivalent to 100 of the underlying. So with that said, we also have to look at our credit of $4.34 with the option contract multiplier of 100. I would collect $400.34. Okay. So with that said, that is anytime you're collecting a credit, that is your max profit. And I would have to have the underlying pin even right at 17 even in order to get that full collection of credit. And it's still going to be a couple of pennies off, to be honest. You can never get all of it with the straddle. So looking at getting out with that. But one thing I wanted to talk about with this, go back one more because I forgot something here. The strategy here, when we set it up, first thing I want you to do is you sell one call, you sell a call and you sell a put, right? That total collection of credit is $4.34. Now, in order to eliminate the downside, I need to buy an option that will still allow me to collect enough credit to pay for the loss I might incur on this short spread. So with that, I've got $4.34. I told you the break even to the downside was like 12 something, right? Well, I'm going to go down. I've got $4.34. If I go down $3 and buy this put, it's going to come out 89 cents out of that, right? So I'm going to have like $3.50. Well, if I get a collection of $3, if I'm getting like a $3.50 credit after buying the put, think about that. $3, that's only $3 wide, and I've collected $3.50. So that means no matter what, that collection pays off this short put loss, right? Because it's only $3 wide. So if I collect $3.50 and the market tanks down that way and is trading $1 even, if it even goes down to $1, I still get 50 cents. Does that make sense how that works? Because a short put spread is $3 wide. That means the max loss you could lose on a short dollar put spread is $3, right? But I've collected $3.50. That means if I lose all of the money and it goes all the way to zero, I still get 50 cents out of it, which is $50 for being wrong. How often do you guys get paid for being wrong? Meaning I thought it was going to stay in a tight range, worried about the downside, and I eliminated it. All right. So if we layer that in there, look, $3.48. I collect $3.48. I've got a short put spread right here. The short put, long put, right there at 14, $3 wide, but I've collected $3.48. So if I go and flip and look at the Analyze tab, I've broken the leg by buying this. It's also limited my profitability by $1 almost, right? Because it was $4.20 some odd cents, right? So I had to buy one. It limited my profit, but it also increased my reward, being that my risk versus my reward is much better than it was with the straddle, right? Because now I can have everything from here going on and still be right. Meaning it's trading $17 right now. The market can rally. I can withstand a rally by $3 all the way up to that value area high that we saw in that one chart, right? Which I was talking about those extremes, $20. Well, look, I'm outside of that by just a hair, but still outside of that a little bit from where I was expecting my resistance to be. So able to have all of that happen and still be right. Now, if we go over and look at this in comparison to the chart, right? If I look at this and say, well, I've got $3.48. My break even to the upside is the 17 plus the 348. So my break even on this trade, break even $17, right? Plus the 348 means my break even is $20.48. So that means it's right here at around this strike, right? This 20 strike. What's the probabilities of this happening? About 36%, 37%. That's usually what we call around the one standard deviation move. So if I'm going back to the bell curve, if I look at this as being positive, so up here would be the calls. We'll say the right side is the calls because it's positive, and the other side is the puts because it's negative. Remember, my thing kind of looked like this, continued, that way to infinity. Well, if we're going to add these up, and I add up the 1.7, all of these all the way along here, basically you come out to, where is it? The one standard deviation move is right around, what is that? It's right around 30. It ends up being right around 34 or something like that. Let's call it 34. So that would be equivalent to the delta. So 36 delta, 37 delta is going to be just slightly inside of here. So ultimately, if we looked at this is where our break-even line crossed, this is basically over there where I was looking at the Analyze tab, is I can have all of this happen on a standard deviation curve. This I don't want to happen. And this is all okay. So when you're talking about probabilities of success, that means market, we start out here at 0 or at 17 in our case, $17. I can have it go all the way up to 20 and still be okay. Check it off, right? Market goes this way, sells off to $0. I get to keep that $48 that we talked about, right? The 348 minus the 3, okay? All right. So we want to try and eliminate all our risk to the downside and, try and nail our point of control and where our short strikes are coming to fruition. And that's about it. Without any other questions, you guys, I guess I'll start wrapping this up. I will circle back around if anybody has any questions. I know some folks are probably watching this a little bit later or delayed. So please comment over at the side. I will make sure you're all clear concept. The other thing is make sure you smash the like button and subscribe with the bell. Subscribe with the bell so you know when I come in and announce. All right, here's our deal. I'm going to throw it in the chat window right now. It should go out to you. Everybody, you got the options course, how to trade options like the Wolfman. I talk in detail how to trade around that point of control there in the market profile. 15 hours of content. I'm showing you how to interest rates. Listen, we just saw the economic data. Fed governors are talking about ramping up, even doing off-meeting eases, which is going to create volatility. So if you haven't gotten on protecting your portfolio from rising interest rates, you really should get on that, folks, because it's a pretty solid trade. Doing covered calls against this is, I talk about how to set it up. Interest rates are probably not going down anytime soon. So your risk to the upside is almost eliminated. And a whole lot more. Make sure you guys take advantage of that. Subscribe, like, and comment. That's all I got for you. Take care, guys. If you can't take that, take it easy.